The Textile Manufacturing Company Limited is considering one of the two mutually exclusive projects M and N. Right, mutually exclusive projects. That means we can accept only one of the two proposals. Either we can accept project M or project N. They require cash outlay of 8,50,000 and 8,25,000. So that's your sigma PBCO. The certainty equivalent approach is used in incorporating the risk. And the current yield on government bonds. So risk-free rate is the rate of return that we are getting on the government bond. So we will consider the risk-free rate of return to be 6%. Then they are saying that the expected net cash flows and their certainty equivalents are as follows. So year-wise, they have given us the cash flow for project M and project N, and also the CE factors. Present value factors are also already given at 6% for year 1, 2, and 3. They are saying analyze which project should be accepted. Okay, which project should be accepted? See, we are going to calculate the net present value. So the project that is acceptable is that project which has the highest positive net present value. So we will work out the NPV of project M, we will work out the NPV of project N, and wherever the NPV is higher, that project shall be selected. And in part 2, they are saying that if the risk adjusted discount rate method is used, identify which project would be appraised with a higher rate and why. Okay, that we can answer only after we have solved the question. So we will just do part 1 first. We work out the NPV. Computation of NPV. Present value factor 6%. Yes. We say project M. Cash inflow. CE factor. Present value. We'll do analysis of the two projects simultaneously. Cash inflow, CE factor, and the present value. Information is given for 3 years. Present value factors are also already given. 4,50,000, 5 lakhs, and 5 lakhs. CE factor 0.8. Just a second. It's 0.8. Then 5 lakhs. We have 0.7, 0.5. We were supposed to prepare a column also for certain cash flow. I'm really sorry. I have to make a slight change in our table. A column was required for certain cash flow. and then the present value. And similarly for the project N, cash inflow, CE factor, certain cash flow, and then the present value. Yes. Here the cash inflow is 4,50,000, 4,50,000, and 5 lakhs. Certainty factors are there, 0.9, 0.8, and 0.7. So let's solve 4,50,000. We do for project M, 4,50,000 into 0.8. So 3,60,000, and then discount it at 0.943. So 339,480. 5 lakhs into 0.7, so that is 3,50,000. Discount at 0.89. 3,11,500. This is 2,50,000. Discount at 0.840. 2,10,000. Total is 860,980. That's the sigma PVCI less sigma PVCO. The project is costing 8,50,000. Difference is the NPV, 10,980. Same way here, 4,50,000 into 0.9. 4,05,000, discount at 0.943. 381,915. This is 3,60,000. Discounted 3,2400. 3,50,000. Discounted 0.840. 2,94,000. Total 9,96,315. This is costing 8,25,000. We get 171,315. So we are in a position to work out the NPV. Whichever project has higher NPV, that will be selected. Recommendation. Right, they are saying analyze which project is acceptable. We say project N should be accepted in view of higher NPV. Simple. Wherever the NPV is higher, that is the project that is selected by us. In part 2, they are saying that if risk adjusted discount rate method is used, identify which project should be appraised with a higher rate and why. Okay. See, what happens in the risk adjusted discount rate technique is project that has higher risk, right? It will be, if you look at the discount rate, we will consider a higher discount rate. And if the project has lower risk, then we will discount at a lower discount rate, right? That is the rationale of the risk adjusted discount rate technique, right? Now, when we did the analysis as per the C approach, project M has lower NPV while project N has higher NPV. Now, why is project N having a higher NPV? It is having higher NPV because it has higher proportion of certain cash flows. You get my point? When you apply the CE approach, you are discounting certain cash flows. Project N is having higher NPV. That means it is having higher proportion of certain cash flows. Now, if you have higher proportion of certain cash flows, then your risk is lower. I hope you get my point. When the certainty of a particular project is higher, when the certainty is higher, that means the risk is lower. Okay, that means project N has lower risk and project M has higher risk. If project M has higher risk, then it will be analyzed at a higher discount rate. If you see part 2, they are saying if risk adjusted discount rate method is used, identify which project would be appraised with a higher rate and why. Project N has higher NPV. That means project N has higher certain cash flows. Higher certainty means less risk. That means relatively project M has higher risk. And if project M has higher risk, it should be analyzed at a higher discount rate. So that's our answer for part 2. We say for part 2, project N has higher NPV as per CE approach. Full stop. This means project N has higher proportion of certain cash flows. Certain cash flows. On the basis of above, it shall be concluded that project M has lower certain cash flows, that is, it has higher risk. It has higher risk. Hence, if risk adjusted discount rate approach is applied, then project M shall be analyzed at a higher at a higher discount rate because of higher risk. Because of higher risk. So this is our rationale for applying a higher discount rate to project M.